We start off with today's big market sell-off and the words that made the doves cry. Despite what many considered a dovish hike, as Federal Reserve Chair Jerome Powell started speaking, stocks started sinking. The market getting absolutely crushed, wiping out a big rally earlier in the day with the Dow ending down about 350 points, closing at the dead lows of the year. Let's get straight to our own Steve Leisman in Washington, D.C., who was at the big Fed Newser today. Hey, Steve.
Hey, Melissa, I think the issue is the market wanted total capitulation from the Federal Reserve, but it got kind of partial capitulation at best. And by that, I mean the Fed market may have wanted no hikes next year. Instead, it's got two still forecast in by the consensus of the committee. The Fed said that further gradual rate hikes are needed. The market, some further gradual rate hikes are needed. The market wanted that phrase entirely removed. But here's Powell now on the change in the rate outlook.
Many FOMC participants had expected that economic conditions would likely call for about 3 more rate increases in 2019. We have brought that down a bit and now think it is more likely that the economy will grow in a way that will call for 2 interest rate increases over the course of next year. We always emphasize that our policy decisions are not on a preset course and will change if incoming data materially change the outlook.
So here's the story. Here's what the market probably wanted, and here's what they got. They wanted 1 hike or none next year. It got 2. At least that's the forecast. Wanted flexibility on the $600 billion balance sheet reduction. Powell kind of indicated there was not going to be very much on that. I think it probably wanted more concern about the economy, that its fears were shared by the Fed. Instead, it got a line that the Fed was monitoring developments. Now, there was one line from Fed Chair Jerome Powell that maybe the market overlooked, and it was a pretty dovish line. Listen to this one.
I think from this point forward, we're going to be letting the data speak to us and inform the outlook and inform our understanding of what would be appropriate policy. So there's a fairly high degree of uncertainty about both the path and the ultimate destination of any further increases.
Despite that, it is hard to get away from the conclusion that stocks and bonds wanted an unapologetically dovish Fed and Fed chairman. Instead, they heard a much more hawkish one than they wanted to hear, Melissa.
You know, it's interesting, Steve, because I thought when he said that and when he answered your specific question, that the markets would actually find some solace, because when you asked him the question, was it the markets, was it trade, was it Trump in the past month or so, he did seem to acknowledge. I felt like we almost got a capitulation from him that they were monitoring what was going on in the global markets. They were observing this volatility.
I think that's right. And I think that's true, by the way, that if stuff doesn't happen the way the Fed expects it to happen, the Fed will do fewer rate hikes if it doesn't see that the rate hikes are warranted. So I'm really going to be fascinated by the conversation around your table today, which I think is really important, because, you know, what did you want the guy to say? Do you want him to be on his knees begging forgiveness for having thought about possibly raising rates next year? And I don't mean to joke or to mock, but I guess I'm joking and mocking.
I think the one thing, though, that he could have added to the whole data-dependent sort of thing is the balance sheet policy. If he made that also seem like that was data-dependent, it wasn't necessarily on an automatic course.
I get that.
Then maybe that would be real, you know, without saying we're not going to raise anymore.
You know, just to be very skeptical on that, Melissa, the balance sheet is suddenly the complaint du jour. And I will tell you, for a year and a half, I reported on the Fed's exact plans to, and in fact, I had trouble getting on a lot of the shows talking about the Fed's plans to reduce the balance sheet, which I thought were important. And I thought when I came on with them, which I do breathlessly, as you know, I thought the market would react, but the market could have cared less. That, you know, you say the Fed in 2019, we knew this like a year ago, was going to reduce the balance sheet by 600. Now, maybe the existence of the lower amounts of liquidity created by that are problematic for the market. However, I will point out we are still some $3 trillion in excess on the Fed's balance sheet of where it was before the financial crisis. So, like I said earlier, if you had 3 feet of water in your basement, and you take out 2 feet, you still got a foot of water in the basement. It's still plenty liquid. So
I would say I have a lot less water, though, in the basement. I'd be happy about that.
But you're still getting your feet wet.
Yeah. Okay. Well, you know, it just took us a little bit longer, Steve, here. You know, not being a senior, you know, economics correspondent or anything, to realize that QT may be actually an impact here. We'll let that stand. Steve, thank you. Great
Sure.
job today. Steve Leisman in Washington. So with the December rate hike in the books and 2 more on the table for next year, what do you do now? And to Steve's point, what did you expect the guy to say? I mean, if that wasn't good enough, I don't know what would have been.
Well, I've become a bigger fan of Chairman Powell today, but that's really not the point. And kudos to Steve, who said yesterday you fade whatever happens, and that proved to be correct in terms of the broader market. And I'm sure he'll provide levels in the S&P. But what you do now, and I think Pete actually might agree with this, I think you wait for a day where the VIX trades north of 30, which, by the way, it probably should be already, but it's not. On a day where the market flushes in the beginning of the day on extreme volume, and then hope that's your capitulation. Quite frankly, we haven't really seen anything along those lines. It sort of looks like it might feel like it, but we haven't seen it. If you're looking for places where I think you can still be, regardless, despite the fact that healthcare got a little whacked today, I still think that big cap pharma is a place to be. I'm not saying you hide out there. We'll talk about that later. But I think on its own, names like Pfizer, names like Bristol Myers, which I think is about to bounce, Eli Lilly, I think they work.
The VIX was what, 26 at its
Yeah, we got
highest
over
today?
26 today, yeah, and we did see a little bit of a spike, but to your point, it's not really quite enough. And maybe that's the problem. Maybe the expectations of guys like me sitting around waiting for that, and maybe it's waiting for Godot, because maybe we're not going to get that. Maybe we don't get that bell that you normally get where you've got that huge flush on volume, as you mentioned, and the big spike in the VIX. Although we have seen more and more buyers of both VXX and the VIX itself looking for some sort of a spike at some point in time. So we'll see how that plays out, Mel. I think that some of the commentary about uncertainty about going forward for Mr. Powell, that's something I actually embraced that, because what that's telling me is they really truly are trying to be
on rates,
right?
On rates,
trying to be data dependent,
not on the quantitative tightening. And
right.
That's what got me concerned. And to Steve Leisman's point, that's the pushback that I heard when we started talking about it in October, that it was factored in. Everyone knew it was $50 billion. Everyone knew it was coming off the balance sheet. But the market doesn't know until the market knows. And $600 billion a year equates to 75% of the Fed's balance sheet from 2007.
Yep.
Put it in proportion.
Right, and you said in October. I mean,
in October.
Yeah. I mean, the view is a little bit different now versus 2 or 3 months ago.
It is. The view's dramatically different, and I think that's what the market was. Why the market reacted. It did. I mean, look at the news that we've had over the last several months, including and up to FedEx saying, you know what, the global economy is slowing. We have almost every single PMI in the world rolling over. You have inflation expectations diving to lows we haven't seen in a long time. You have a slowing global economy, and the Fed's out there saying, hey, the economy's strong. We topped it back from 3 to 2, but there was no acknowledgement whatsoever, and it seemed a bit tone deaf to me that the economy has slowed. The global economy has slowed, and I think that's why
but he
the
said
market
about
rolled
rates.
over.
He said there was flexibility on rates, but there's zero flexibility, and that's what spooked the market today. That, and he doesn't know where the signs of inflation are or why they've been
They're
low.
not there.
So there's two things why the market
Right.
collapsed. Those two things.
Guy, what do you
And in inflation can't be careful what you wish for, because if we get inflation, it's going to come in a very
I think it's
meaningful
scary that they
way.
don't know where it is.
Inflation is in all the wrong places. That's another conversation. It doesn't matter. I mean, we can't get wage inflation. That's what they're dying for. It's just not there. Have you been to a doctor recently? I mean, inflation in healthcare is pretty meaningful. Again, a much different conversation. And in terms of a balance sheet, Fed should never had a $5 trillion balance sheet in the first place. I mean, we can argue the reasons why it got there and the reasons why it stayed there. When it was $5 trillion for an extended period of time, nobody seemed to care. Now we're starting to whittle it down correctly. There's a problem. And I've said this on air many times. It's easy to get into a trade. That's the easiest thing to do. Getting out is the hard part, and that's what they're trying to do now.
Whittling down the balance sheet, though, is the equivalent of raising every meeting. So if when you raise a quarter point and then you whittle down the balance sheet, you're raising by 50 bips. You're raising by a half a point.
I mean, Steve Leisman said something before, and he said something to the effect of $1 in stimulus doesn't have the same impact when you take that $1 off. It has a much bigger impact when you're going in than when you take it off. But in terms of the market reaction, did the markets overreact today?
Well,
I mean, do you
you're
think
going to
that the
stir it up between the two of us,
Yeah.
because I already know the answer. I feel like, yes, the answer is yes. I did think it was an overreaction, because I thought that Chairman Powell handled himself very, very well. Obviously, the initial reaction to the upside was just all based on exactly what they did. Then all of a sudden, the more questions that he answered, suddenly we just see this whoosh to the downside. And it just seems to me it's, again, one of these days, 600-point moves throughout the day when you look at the intraday moves. I think it's ridiculous, and I still think that's a combination of of computers and a lot of other things, algorithms that kick in, that all are triggered by specific words that come into the market.
Where do I start? I mean, let's just take the computers out of it.
So let's
take the computers. Computers work on the upside and the downside. That's the most ridiculous thing in the market.
No, that's not true. That's not true. The magnitude of the move to the downside is far more exaggerated than the magnitude of the upside. If you take a look at the ups and the downs, you absolutely will see that prove out.
Okay, but whether is that computers or not, they work on both sides. It's not like all of a sudden quants go, hey, wait a second, today we're going to sell everything off. People, that's just market.
It would be better if they did. It's just a word that
overreact on the
triggers
fear.
On that stuff.
People overreact on
so
fear.
you're telling me that word was. I mean, when I think about, and I listened to this whole press conference was fascinating. But was there anything in it that what do you think triggered those?
That's the question for us.
To me, it was when they said that the economy is strong and that gradual increases are still warranted. That left me scratching my head.
It's the dissonance between his view of the economy and the market's view of the economy, and the concern that he will continue, and the market's wanting to be
and
slow.
the actual data points that show everything rolling over.
Mm-hmm. Yeah. What did you think the markets overreacted today?
Overreacted? I mean, in terms of the magnitude of being up 250, 300 to being down 400, I mean, to me, that's an overreaction. And I know what BK is saying. I do think the moves are exacerbated on the downside by the machines. But quite frankly, the machines probably were the reasons why we go up every day for the last 8 or 9 years as well. So, I mean, again, a much different conversation.
Markets can't overreact. They react.
You see it until
you
see, in my opinion, a 30 handle in the VIX. That, to me, is when you start getting into overreaction.
How does the reaction that we saw today educate our trading? And I'm specifically thinking of the flattening that we saw on the yield curve shortly afterwards.
Obviously, the flattening of the yield curve, people are worried about growth. People are worried about banks. When the yield curve inverts, the economy stops. Now, I understand someone's going to say that it takes 18 months to 2 years. Maybe that person rhymes with Oni Iyer, but I get that. But the markets are forward looking.
Pete, we had Dick Bassovich on. Formerly of Wells Fargo on Power Lunch today.
Yep.
And he was basically saying, the banks are, concerned about the global economy. He didn't mention the yield curve at all.
No, he didn't. But he did talk about loan growth and that type of thing, and that being somewhat of an issue. I mean, he brought up a lot of different things, and he talked about the economy itself. It was interesting what he had to say because everybody, including me, is trying to figure out what will finally get the banks to actually react to the upside. And we haven't found it yet, Mel. Despite the fact that we've seen some record numbers on earnings and all these various things, nothing's been able to push them higher.